Okay, let's get right into it. When you first look at Alibaba's latest quarterly report, it's a bit of a head-scratcher. But if you dig into these numbers, there's a really fascinating story here about a giant company making some huge, and I mean really expensive, bets on its own future. So today, we're going to unpack all of that.
And this slide right here, this is the core of the mystery. How in the world can a company actually bring in more cash from sales, but at the same time see its actual profit just fall off a cliff by 66%? It feels totally backward, but that's the central puzzle we're going to solve.
So, let's unravel this thing. We're going to start by looking at the parts of the business that are actually firing on all cylinders.
So where's the good news? Let's kick things off with where Alibaba is pouring its resources and, betting on the future.
The company has been super clear about this. Its whole strategy is laser-focused on two main pillars. You've got the high-tech side of things, that's artificial intelligence and the cloud, and then you have their massive consumer e-commerce empire.
And in that first pillar, the AI and cloud division, the results are genuinely pretty impressive. This is where the company is seeing some really explosive growth, and believe me, the numbers definitely back it up.
Take a look at this. A 35% jump in revenue from their external cloud customers. So this means more and more companies out there are actively choosing Alibaba for their cloud needs, and that growth is actually accelerating. That is a huge vote of confidence from the market.
Now, what's really wild about this is the consistency. We're talking 10 straight quarters. That's 2.5 years of triple-digit growth for their AI products. This is not a flash in the pan. It's a sustained strategic push that is clearly working in terms of getting people on board.
And this gives you a perfect picture of the two sides of the company's focus. You've got Qwen, which is their advanced large language AI model, representing the tech of the future. And right next to it, Taobao, their original massive e-commerce platform. It's really the tech of tomorrow fueling the commerce of today.
Okay, let's switch gears to that other engine, consumption. Because it's not just about the high-tech stuff, they're also seeing more people flocking to their shopping sites and using them a lot more.
To get specific, their main app, Taobao, saw a double-digit surge in monthly users. And a huge driver for this? Their big investment in what they call quick commerce, which is basically super fast delivery that gets you your stuff faster than ever. And consumers are clearly loving it.
And their reach is absolutely global. A lot of you will know the meme AliExpress, right? It's a huge part of their strategy to connect Chinese manufacturers with the entire world.
And then you've got Lazada, which is a powerhouse in Southeast Asia. This just goes to show you the massive scale of their e-commerce ecosystem. It's so much bigger than just their home market.
Okay, so the growth is definitely real, and it's happening in really important areas. But this brings us right back to our original puzzle. All this great news is coming at a very, very steep price.
I love this analogy because it nails the situation perfectly. Imagine a store that is absolutely packed with shoppers, which sounds great, right? But the profit on every single item they sell is shrinking. And on top of that, the rent, the electricity, the staff costs, they're all going up. That's the challenge in a nutshell.
And you can see it right here in black and white. Revenue? Yeah, it ticked up a little, from about 280 billion RMB to 285 billion. But look at net income, a staggering drop from over 46 billion all the way down to just 15.5 billion. The numbers just don't lie.
And it's not just about net income either. There's another really crucial measure of a company's financial health that tells a very similar and pretty concerning story. I'm talking about free cash flow.
So what is free cash flow? Well, to put it simply, it's the actual cash a company has left over after it pays for everything it needs to run and grow. Day-to-day bills and big investments. It's the money you can use to innovate, pay off debt, or give back to shareholders.
And this chart just makes the situation crystal clear. A year ago, Alibaba had over 39 billion RMB in free cash flow. This quarter, a little over 11 billion. That is a dramatic drop in the actual cash they have on hand.
So this all begs the question, is this the company in trouble, or is this all part of some grand plan? I mean, what kind of strategy leads to numbers like these?
Well, here's the crucial takeaway. This seems to be a deliberate choice. The strategy is to invest, and invest heavily in those growth areas we talked about. They are making a conscious decision to accept lower profits right now to win the fight for market share and long-term dominance. It's all about prioritizing future growth over today's bottom line.
So, at the end of the day, it's a massive gamble. Alibaba is basically pushing all its chips to the center of the table. They're sacrificing the comfort of big profits today for the hope of securing an even stronger, more dominant position in the market for years to come.
And that leaves us with the big unanswered question, doesn't it? The strategy is clear. Spend now to win later. But in this fast-moving world of tech and e-commerce, the clock is always ticking. Will these enormous investments in AI, in the cloud, in their consumer businesses, will they start generating serious profits before investors lose their patience? That, my friends, is the billion-dollar question.